Welcome back to the channel, and thanks for joining me. I'm Algabot, and today we're taking a close, educational look at an expert advisor for MetaTrader 5 called Wick Rejection Continuation. This is a trend-following approach built around a single moving average, the 50-period exponential moving average, and the way price behaves when it pulls back toward that line. Over the next few minutes, we'll walk through the core idea, the exact entry and exit rules, the actual MQL5 code, and a candle-by-candle chart illustration. Everything here is for educational purposes only. Let's get started. So what exactly does this expert advisor do? At its heart, Wick Rejection Continuation is a trend continuation strategy. That means it does not try to catch tops and bottoms or trade against the prevailing direction. Instead, it waits for an existing trend and looks to join that trend after a temporary pause. The tool that defines the trend here is a single exponential moving average, set by default to a 50-period length. The strategy runs on one symbol and one time frame at a time, and it only ever holds one position at a time, which keeps the logic clean and easy to follow. The behavior it looks for is very specific. In a healthy trend, price rarely moves in a straight line. It pushes forward, then pulls back toward the moving average to catch its breath, and then, if the trend is still intact, it resumes. This strategy is designed to detect the moment that pullback fails. When a candle dips toward the moving average but is firmly rejected, leaving a long tail or wick and closing back on the trend side, that rejection suggests buyers or sellers have stepped back in and the dominant trend is resuming. Because of this design, the approach is generally suited to traders who prefer to trade with the trend rather than against it, and who are comfortable with a rules-based, mechanical style. It uses the average true range, or ATR, to size its stop loss and its trailing stop, so it adapts to how volatile the market currently is. It also aims for a fixed reward-to-risk multiple, locks the trade to break even once it moves in favor, and then trails the stop as the move extends. Remember, this is educational information, not financial advice, and trading always involves the risk of loss. Let's break down the exact logic the expert advisor follows, step by step. Everything begins with the trend filter. On each newly completed bar, the strategy reads the exponential moving average at the signal bar and compares it to the moving average a few bars earlier, using the SlopeLookback parameter, which defaults to 3. For an uptrend, it requires two things at once. The closing price must be above the moving average, and the moving average must be rising. For a downtrend, it needs the mirror image, price below the moving average and the moving average falling. Once the trend is confirmed, the strategy examines the candle that just closed and measures its anatomy. It calculates the body, the upper wick, and the lower wick, along with the full range of the candle and the current ATR. For a long setup, it looks for a bullish rejection. The lower wick must be dominant, meaning it is at least the wick ratio multiple of the body, which defaults to 2. It must be at least half of the entire candle's range, and it must be larger than the upper wick. On top of that, the candle's low must reach down to within a small ATR-based proximity of the moving average, confirming that price genuinely tested the line before being pushed back up. For a short setup, everything is reversed. The upper wick must dominate, reach at least half the range, exceed the lower wick, and the candle's high must poke up to within proximity of the moving average before closing back below it. When a valid long signal appears, the strategy enters a buy at the ask price. The stop loss is placed just beyond the rejecting wick, padded by the stop loss ATR multiple times the current ATR. The distance from entry to that stop becomes the defined risk, and the take profit is set at the reward-to-risk multiple, by default 2 times that risk. Short trades work the same way in reverse, with the stop above the wick. After the trade is open, management kicks in on every tick. Once price advances by the break-even or multiple, the stop is moved to the entry price to protect the position. From there, an ATR trailing stop follows price at the trail ATR multiple distance, tightening only in the favorable direction. A spread filter also blocks entries when the spread is too wide. Let's look at the actual MQL5 code that runs inside MetaTrader. At the top, we have the input parameters. EmaPeriod sets the moving average length to 50, and SlopeLookback of 3 controls how far back we measure its slope. WickRatio, defaulting to 2, decides how long the rejecting wick must be relative to the body, while proximity ATR governs how close to the moving average the wick has to reach. ATR period feeds the volatility calculation, and the stop-loss multiple, reward risk, break-even R, and trail multiple shape the stop, the target, the break-even move, and the trail. Lots and max spread points handle position size and the spread filter. Now the two signal blocks. In the buy block, the code checks that we're in an uptrend and that bull reject is true, meaning the lower wick clears the wick ratio, covers at least half the candle's range, exceeds the upper wick, and the low reaches near the moving average. When that holds, it reads the ask price, sets the stop-loss 1 ATR multiple below the wick low, computes the take profit as the reward risk multiple of that risk distance, and calls trade.buy. The sell block is the exact mirror. It confirms a downtrend and that bear reject is true, where the upper wick dominates, covers half the range, exceeds the lower wick, and the high reaches up near the moving average. It then reads the bid price, places the stop-loss 1 ATR multiple above the wick high, sets the take profit below entry at the reward risk multiple, and calls trade.sell. Both sides share the same clean, symmetric structure. Now let's bring it all together on the chart, walking through both a long trade and a short trade in sequence. The blue line running through the candles is the 50-period exponential moving average, our trend reference for the whole illustration. Look at the left side of the chart. Price is stair-stepping higher, and each candle is holding above the rising moving average. This is exactly the environment the strategy wants for a long. Price above the line and the line sloping upward, both conditions confirming an uptrend. After a few strong candles, momentum pauses and price begins to drift back down toward the moving average. This is the pullback, the temporary breather within the larger uptrend. Watch the pullback candle closely. It dips down and its low pierces right into the region of the moving average, testing that line from above. But instead of closing there, price is firmly rejected. The candle leaves a long lower wick, a tail that stretches well below its small body, and it closes back up on the trend side of the moving average. This is the bullish rejection the strategy is built to detect. The dominant lower wick, reaching at least half the candle's range and dwarfing the body by the wick ratio, tells the expert advisor that the pullback has failed and the uptrend is resuming. On the very next candle, you can see the buy entry marker. The strategy enters long at the ask, and it places its stop just below the rejecting wick, padded by a fraction of the ATR. The take profit sits above at twice the risk distance, our 2-to-1 reward to risk multiple. From there, price does what the setup anticipated. The following candles push firmly higher, one after another, until price reaches the take profit target and the long trade is complete. Along the way, once price advanced far enough, the stop would have been moved up to break even and then trailed behind price by the ATR trailing distance. Now the market character changes. Notice how price rolls over near the top, and the candles begin closing below the moving average while the line itself flattens and turns lower. This flips our trend filter. Price is now below the moving average, and the moving average is falling, which defines a downtrend. The strategy stops looking for longs and starts watching for a bearish rejection. Here comes the mirror image of what we saw before. Price bounces back up toward the falling moving average, and one candle pokes its high right up into that line. Again, it is rejected, but this time to the downside. The candle prints a long upper wick, a tail above a small body, and closes back below the moving average on the trend side. That upper wick dominates the candle, exceeds the lower wick, and reaches up near the line, which is precisely the bearish rejection condition in the code. On the next candle, the sell entry marker appears. The strategy enters short at the bid, sets its stop just above the rejecting wick, and places the take profit below at the same 2-to-1 reward to risk multiple. Price then slides lower through the following candles, extending the downtrend until it reaches the take profit target, completing the short trade. Notice how, in both directions, the entry only came after price tested the moving average and was rejected, keeping every trade aligned with the prevailing trend rather than fighting it. And that brings us to the end of our walkthrough. Today we explored the Wick Rejection Continuation Expert Advisor for MetaTrader 5. We covered how it uses a 50-period exponential moving average to define the trend, how it detects a rejected pullback through the dominant wick, and how it manages each trade with an ATR-based stop, a fixed reward-to-risk target, a break-even lock, and a trailing stop. We also read through the actual MQL5 code and watched a full long and short example on the chart. Remember, everything in this video is educational information only and not financial advice, a recommendation, or a solicitation to trade. Trading carries real risk, and losses do happen. If you found this breakdown helpful, please like the video, leave a comment, and subscribe for more MT5 strategy analyses, and visit www.algobot.live to learn more. Past performance does not guarantee future results. Trade responsibly.